So thank you very much for joining us tonight. I'm going to start by telling you a bit about the Federal Reserve for those of you who walked in toward the end of Joe's presentation, and why we value the opportunity to interact with all of you in events like this one. Then I'm going to share some thoughts on inflation, which is one of the key variables that the Federal Reserve affects with its monetary policy. I'm going to describe 5 major factors that affect the inflation rate, and I'll argue that together, these factors mean inflation is likely to run low for some time to come. I plan to leave plenty of time at the end for your questions on that issue or any others that may interest you. Let me note that the views I express today are mine and not necessarily those of anyone else at the Federal Reserve Bank of Minneapolis or the Federal Reserve System. So as you probably know from Joe's presentation, but you may not know if you've never been here before and just walked in, the Federal Reserve is our nation's central bank. We supervise commercial banks to ensure their safety and soundness. We operate parts of the payment system. And we conduct monetary policy, which basically means setting interest rates, to achieve 2 goals assigned by Congress: maximum employment and stable prices. The second of those 2 goals, stable prices, is going to be my main theme for tonight. So the Fed consists of the Board of Governors in Washington and 12 reserve banks responsible for districts around the country. And the Minneapolis Fed covers the 9th district, which includes Minnesota, the Dakotas, Montana, and parts of Wisconsin and Michigan. The Fed's monetary policy arm is the Federal Open Market Committee, or the FOMC. And the FOMC consists of the members of the Board of Governors and a rotating group of presidents from the reserve banks. But even though a subset of the reserve bank presidents vote at any given time, they all participate in the discussion, and they all share their views on the economy and on monetary policy. So this decentralized structure means that a crucial part of our reserve bank's work is to gather information about the local economy and bring that information to Washington, where it is used in determining the course of policy. And then to bring information about monetary policy back to our district. So we highly value everything we learn from talking with people like you in communities throughout the district, and I look forward very much to your questions and comments. So how is the economy doing? As I mentioned, the Fed's goals are maximum employment and price stability. On employment, the economy has made enormous progress since the Great Recession. The national unemployment rate, for example, has come down from 10% in late 2009 to 5.1% as of last month, and we've made similar progress right here in Minnesota. Other measures of labor market activity have also improved, but not always by as much as the national average unemployment rate. Some Americans still struggle to find well-paid work, or enough work, or any work at all. Now let's turn to price stability. Since 2012, the FOMC has interpreted the price stability goal to mean an inflation rate of 2% over the longer run, as measured by the Price Index for Personal Consumption Expenditures, or PCE. So let me emphasize that this index measures the prices of all goods and services, including food and energy. People sometimes think that we're leaving out some prices. We're not. We're including all of them in this index. And inflation is the rate of change in the average level of prices in the economy. So when inflation is 2%, prices are rising on average by 2% a year. That doesn't mean every price goes up by exactly 2%. In any given year, some prices go up and others go down. The inflation rate is what happens to the average. So here's what's actually happening to inflation. And as you can see, inflation has not been 2% lately. In fact, inflation has fallen short of the FOMC's goal for more than 3 years. Prices on average are rising quite slowly, just 0.3% over the past year. Now you might think this is good news, because who wants to pay higher prices? But it turns out that below target inflation is not the bargain you might expect. Although low inflation holds down prices, it also tends to hold down workers' incomes. This can pose a problem for people who have mortgages or car loans with fixed payments. If a family took out a loan expecting their income to grow in line with the 2% inflation target, but inflation actually comes in lower, the loan payments will be more difficult to make than the family expected. Of course, unexpectedly high inflation can cause problems for other families, those that have made investments at a fixed interest rate, like retirees who are receiving annuity payments. These families lose purchasing power if high inflation catches them by surprise. So as a result, when inflation misses the target on either side, above or below, some people benefit and others lose money. Keeping inflation as close as possible to the target prevents this kind of accidental redistribution. Economists have identified a variety of factors that influence the inflation rate. I want to talk about 5 of them this evening, and as I said, I'll argue that these factors together suggest that inflation is more likely to run below the 2% target than above it for some time to come. The first major factor affecting inflation is external shocks, like a change in the price of oil or in the exchange rate between the US dollar and other currencies. In the short run, these shocks can significantly affect the inflation rate. Inflation is so low right now, in large part because the price of oil has fallen sharply and the US dollar has appreciated strongly over the past year. A drop in the price of oil not only reduces the cost of fuel at the pump, but it also reduces the prices of other goods and services, like air travel, that rely heavily on oil as an input. Similarly, when the US dollar is strong, imported goods are cheaper, which reduces their prices and the overall inflation rate. Now, although external shocks are important in the short run, they tend to matter less over the medium and longer terms. If the price of oil falls in half this year, inflation, which is the rate of change of prices, will be low this year. But unless oil prices fall in half again next year, which I think is unlikely, though admittedly not impossible, oil prices won't greatly reduce next year's inflation rate. So the inflation rate over the longer run depends more on the remaining factors that I'll describe. The second factor affecting inflation is the money supply. Imagine a world where the total supply of money was $1. Prices would have to be very low because the total cost of all the goods and services that everyone in the world wanted to buy at a given moment would have to add up to no more than that $1 that would be all the money in the world. Now, conversely, when there is more money chasing the same amount of goods and services, prices can be higher. Thus, increases in the supply of money can lead to inflation. But this story is incomplete, very incomplete. Here's a graph of the monetary base, the total amount of currency in circulation, plus bank reserves, or in other words, the total amount of money that the Federal Reserve has put into the US economy. Since 2008, the monetary base has risen by a factor of nearly 5, as the Fed has undertaken a series of extraordinary programs to help the economy recover from the financial crisis. But despite this 5-fold increase in the monetary base, prices have not gone up 5-fold. In fact, the PCE price index has risen by just 11% over that time, an increase so small compared with the increase in the monetary base that you can barely see it on this graph. In a very mechanical sense, the increase in the monetary base has not led to high inflation because money causes inflation only when it is actually chasing goods and services. And the vast majority of the additional money the Fed has supplied is not chasing goods and services. It is simply sitting still as bank reserves. To understand why this money sits still, why it doesn't circulate in the economy and raise prices, we need to consider several other factors that affect inflation. The third factor driving inflation is the strength of the economy. When employment is high and few people are out of work, companies will feel pressure to raise wages to attract and retain workers. And those higher wages will push employers to charge more for whatever it is that they sell. Likewise, when businesses see robust demands for their products and services, they'll feel they have room to set higher prices. Economic activity also helps explain why money sometimes stays parked in the bank with no inflationary effect, and other times circulates in the economy, pushing up prices. When the economy is strong, households and businesses will have more desire to borrow money to consume and to invest. Banks will lend out their reserves, more money will circulate, and inflation will rise. On the other hand, in a weaker economy, there won't be as much demand for loans, and bank reserves won't go anywhere. From this perspective, the low inflation rate, despite a large expansion in the monetary base, demonstrates just how severely the financial crisis hit the US economy. Even 6 years into the recovery, demand for loans simply isn't strong enough to pull very much of the expanded monetary base into circulation. So overall, we might expect a strong economy to feature higher inflation. But does it actually happen? One version of the relationship between economic activity and the inflation rate, a graph plotting inflation and unemployment, is called the Phillips curve. And so this is that graph. In the 1950s and the 1960s, the pattern was strong. High unemployment was associated with low inflation, and vice versa. But this relationship is actually not so robust. So in the 1970s, the pattern reversed, and we saw stagflation, high unemployment along with high inflation. More recently, the Phillips curve has been fairly flat, with large decreases in unemployment accompanying only small increases in inflation. The Phillips curve relationship gives us some reason to expect that inflation will rise as the economy continues to improve, but we should not expect these rises in inflation to be dramatic. Why is the Phillips curve so flat? A key reason is the fourth factor driving inflation, where inflation is today. It turns out that inflation is more or less what statisticians call a random walk. The best guess for the inflation rate in the future is whatever the inflation rate happens to be today. Indeed, a long line of research right here at the Minneapolis Fed has found that given the inflation rate today, the unemployment rate has little additional predictive power for future inflation. This inertia in inflation is particularly strong if we strip out the transitory effects of external shocks like oil prices. Economists thus often forecast future inflation by looking at the so-called core inflation rate. The core rate is less volatile because it excludes food and energy prices, and this makes it a useful predictor of where total inflation, including food and energy, is likely to go in the future. So here is the core inflation rate. As you can see, except for a brief period in 2012, it has been below the FOMC's 2% target for nearly 7 years. Because inflation displays so much inertia, this long period of below-target core inflation suggests that we are likely to continue to have low total inflation in the future. Now, although inflation seems to act statistically like a random walk, future inflation is whatever inflation is today, it's important to remember that inflation is not just a statistic. It measures changes in prices that are set by actual companies and actual human beings. And so to understand what drives inflation, we have to also think about what drives the behavior of those real companies and real people. Most companies do not like to change their prices constantly. It would be a waste to have workers constantly walk up and down the store aisles or to constantly reprint restaurant menus in order to minutely adjust the price of every item every minute in response to new bits of information. Indeed, this is one reason why maintaining stable prices helps the economy grow. If inflation were extremely high, stores would need to have their workers constantly raise prices to keep up. And that would waste resources that could better be used in more productive endeavors. But because companies don't like to change prices too often, when they do change a price, they have to make a guess about what the right price will be for some period of time into the future. And in making that guess, they need to take into account their expectations of how inflation will behave. If they expect high inflation, rising prices in the rest of the economy, and especially for their competitors' goods and services, the right price to set today will be higher than if these companies expect low inflation. Thus, the final factor affecting inflation is inflation expectations. When people expect higher inflation, we tend to get higher inflation. When people expect lower inflation, we tend to get lower inflation. Expectations are also a key channel through which a central bank can influence the inflation rate. If people expect the central bank to provide more monetary stimulus to the economy in the future, then they will expect more upward pressure on inflation in the future, both from the expanding money supply and from stronger economic activity. But as we just discussed, expectations about future inflation can affect the inflation rate today as well. Thus, the Federal Reserve shapes the inflation rate not only through its actions today, but also by setting expectations about the actions it will take in the future. So let's take a look at a few measures of people's expectations for inflation in the United States right now. The survey of professional forecasters asks expert economists, none of whom work for the Federal Reserve, these are all outsiders, but many of whom advise large companies that make important decisions about price setting, what they think inflation will turn out to be over the next year and over the next 10 years. And there are data both for the PCE inflation rate that the FOMC targets and for something called the Consumer Price Index, or CPI. And this CPI is the same kind of thing. It's a measure of average prices in the economy. But it uses a slightly different formula, and it tends to be a little higher than the PCE rate. So the median forecaster in this survey of professional forecasters predicts a PCE inflation rate of 1.8% over the next year. Over the next 10 years, the median forecaster predicts a CPI inflation rate of 2.2%, which is equivalent to a PCE inflation rate just slightly below 2%. In other words, These professional forecasters expect inflation to run a bit below the FOMC's 2% target in the short run, but to rise near to it in the long run. Besides seeing what professional forecasters think, we can look at the expectations of ordinary families. For many years, the University of Michigan has surveyed consumers about their inflation expectations. The people in this survey currently expect inflation of 2.7% over the next 5 years, and slightly higher over the coming year. The Michigan survey tends to show somewhat higher inflation numbers than the survey of professional forecasters, and also somewhat higher than the statistical data on actual inflation. So why is that? Well, we don't exactly know, but one conjecture is that the inflation rate is an average of all the prices in the economy and how all of those prices are changing. And so if you ask someone what they think inflation will be, they have to think how to average prices. People who are in this Michigan survey of consumers may have a different mix of prices in mind than the actual total mix of prices in the overall economy that statisticians use to compute the actual inflation rate. So longer-term survey-based expectations, like the 5-year measure in the Michigan survey and the 10-year measure in the survey of professional forecasters, are remarkably stable. They don't seem to move around much in response to economic developments. And you can see that on this graph. There are huge fluctuations in the short-term inflation expectations during the Great Recession. The long-term expectations go essentially nowhere. Now, there are two ways to interpret this stability. It may be a welcome sign that inflation expectations are well anchored, that families and businesses are confident that the Federal Open Market Committee will indeed deliver on its 2% inflation goal. But the stability of long-term survey expectations could also mean that the respondents in these surveys just aren't trying very hard to give an accurate answer. Maybe they just always say 2. So another way to measure inflation expectations is to look at investors' behavior in financial markets. We have to be really careful in interpreting these measurements because they're based on investors' demands for various financial securities, things like nominal treasury bonds versus treasury bonds whose interest is adjusted for inflation. And what these investors want to buy might not represent what the average household thinks. But compared with surveys, we can be more confident that financial market expectations at least reflect a serious effort at accuracy. These investors do have to put their money where their mouths are. So this graph shows investors' inflation expectations over the period 5 to 10 years in the future. For example, the last point on the graph shows the inflation rate that investors expect to prevail between 2020 and 2025. And that rate is 1.84%. These financial market expectations are measured relative to the CPI, the Consumer Price Index. And as I just mentioned, the CPI tends to run a little higher than the PCE index that the Fed targets. So the market data imply that in terms of the PCE index, investors are expecting an inflation rate around 1.5 to 1.6% over the period 5 to 10 years from now. And again, that's 2020 to 2025. So we're not talking about oil prices are moving around right now. We're not talking about the dollar is moving around right now. By 2020 to 25, all that should be well into the rearview mirror. And way out there, these financial market investors are expecting this inflation rate of 1.5 to 1.6% by the Fed's measure. And looking at this graph, the other thing you notice, besides the low number, is that these financial market expectations have come down substantially over the past year and over the past month. That change suggests that recently, investors at least, have become concerned about the prospect that inflation might run below the FOMC's 2% target for many years to come. So altogether, the available measures of inflation expectations suggest that people expect inflation, on average, to run below target for a while, though perhaps to rise back to the target in the medium and longer runs. Those expectations will help dampen actual increases in inflation over the coming months and years. The expectations channel also helps explain why the expanded monetary base hasn't produced more inflation. Remember, going back to that graph, the mystery of how the monetary base went up by a factor of 5 and inflation only went up 11%. So the more inflation banks expect, the more they'll want to lend out their reserves and collect interest on loans so that the value of their assets keeps up with inflation. Banks' willingness to keep their reserves on hold, so to speak, sitting in the bank, instead of making loans, demonstrates an expectation that the FOMC will maintain price stability by reducing monetary accommodation when the economy no longer needs it. So to sum up, I've mentioned 5 major factors affecting the inflation rate. First, external shocks like changes in the price of oil or the exchange rate can push inflation around in the short run. Second, an expanding money supply can drive up inflation, but only if the added money circulates in the economy, not if it stays parked in banks. Third, inflation tends to rise when the economy strengthens, but not by very much on average. Fourth, inflation shows a lot of inertia. Low inflation today presages low inflation tomorrow. And fifth, expectations matter. The less inflation people expect, the less we tend to get. Now, at the moment, inflation expectations, putting together the survey data and the market data, are on the low side, and so is inflation itself. Thus, although the economy is continuing to get stronger, inflation seems likely to run below the FOMC's 2% target for some time. Thank you for listening. I'd be happy to answer any questions.
Why do we have the continuing drama of every month or so that they're going to raise interest rates? Why don't they listen to you? And the wisdom that these numbers project is that the economy is going to continue where it is at lower interest rates, at low rates.
So that's a fantastic question. It's probably better asked of the people who are not listening to this presentation. I can't really speak for them. I will say, so what are the considerations that are mentioned in the public in thinking about interest rates? On the one hand, the FOMC has an inflation target, and it's important to provide the right amount of stimulus to get inflation back up to the target. On the other hand, one might be concerned that if you let unemployment get too low, that let the economy do too well, inflation could take off all of a sudden. That's happened in the past, and if for people who view that as a risk, that's a concern that they might want to try very hard to avoid. In addition, some people have raised concerns that low interest rates, although they might be the best way to get inflation back up to the target and to stimulate employment, might cause issues for the stability of the financial system. That's really a whole separate topic, and I'm not going to have time to get into that. But if one were concerned about the stability of the financial system and thought that low interest rates destabilize the financial system, which is tricky because some people argue that actually raising rates would destabilize the financial system. But if you thought that, you might be willing to raise rates even if it meant that you weren't getting inflation back to target as quickly as possible. So those are some of the arguments that have been raised in public debate. But as I said, that question is probably better asked of other people.
Could you comment on what causes the appreciation of the dollar as opposed relative to other currencies?
So in general, exchange rates move around because of how much investors want to hold different currencies. If the dollar appreciates relative to other currencies, that means that people around the world want to hold more dollars and less of something else. And in this case, it's been very broad-based appreciation against virtually all major currencies. So people want to hold more US dollars and less of all these other currencies. That tends to come from a couple things. One is how much people want to buy the goods and services that different economies produce. If people want to buy a lot of US goods and services, they need to have a lot of US dollars. If what they want to buy are goods and services made by other countries, then they need to have more of the currencies of those other countries. So for example, the currencies of Mexico and Canada have depreciated a lot recently relative to the US dollar. A major cause of that is that the price of oil has dropped. Those countries are major oil producers. The price of oil dropped because people didn't want to buy as much oil. If people around the world want to buy less oil, they also need fewer Canadian dollars, fewer Mexican pesos to do so. And that causes those currencies to drop relative to the US dollar. The other reason that exchange rates can move around is differences in expectations about interest rates in different countries. So if people believe that interest rates will be higher in the United States than in other countries, then they'll tend to want to invest in the United States to collect those higher interest rates. To invest in the United States, they need more dollars, and that will tend to drive up the US dollar.
I have a question regarding elements of how you measure inflation. Why aren't non-federal taxes included in the cost of living? Local property taxes and income taxes in this state are going up 3 or 4% a year, and they have been. the combined cost of food, clothing, and shelter is less than the combined cost of taxes. So by ignoring them, to a certain extent, you're drinking your own Kool-Aid. And more specifically, you said earlier that low oil prices act as a damper on the cost of air travel. Perhaps you could send a message to Richard Anderson, the CEO of Delta. I believe he lives in a suburb of Atlanta, but he and the other three CEOs that control 85% of the air travel in this country have rapaciously increased airfare, and the fact that oil prices are down seems to not deter them. So you have stated what's supposed to happen. Unfortunately, those of us that have to buy tickets live in a different world, so perhaps.
So great questions. First of all, how do taxes figure into the inflation rate? And second of all, what's going on with airfares? So I'll take them in reverse order, airfares. I think it's important to think about this as a thought experiment. What would have happened to airfares if oil prices had stayed high? Right? So I'm not, I didn't look at airfares right before I came in here, so I don't know the exact number. But I think it's a safe bet that if oil prices had stayed high, airfares would be even higher than whatever it is that they are. So all else equal, lower oil prices do reduce airfares. That doesn't mean that airfares are necessarily cheap, because all kinds of other factors drive airfares. The monopoly power that airlines may have in some markets, the other costs of their other inputs, things like what they have to pay their workers, things like what it costs to buy an airplane, those all drive airfares. But all else equal, the cheaper oil is, the lower airfares will be. Okay. So second of all, how do taxes figure into the inflation rate? The inflation rate that we look at, the inflation rate for personal consumption expenditures, measures the prices of goods and services that are bought by or on behalf of households. So this incorporates a wide basket of things either that people pay for directly, right? Actual goods and services that you go out and pay for when you go to the grocery store and buy groceries, when you go to the gas station and get gas, or if you buy a car, or if you rent a house. It also includes some things that people don't pay for directly, but that are on behalf of individual people. And the best example of this is medical care. Right? So if you go to the doctor and you've got health insurance, you pay some money to the doctor, a copay, and your insurance company also pays some money to the doctor. Right? Now, what happens if the doctor changes their price? Often your copay is completely fixed by the insurance plan for many years at a time. Right? You may have a $50 copay. And if you've got a plan with a $50 copay, odds are that it stays right at $50 for several years. Meanwhile, the doctor is changing their prices in the background, and that changes what the insurance company has to pay to the doctor. Right? So it's important, if we want to know what's really happening to the cost of medical care, to take account of these insurance company payments to the doctor, which are really on your behalf for your health care. Right? So this PCE index accounts for all these payments not only directly by you, the copay to the doctor, but also on behalf of you, what the insurance company pays to the doctor. Right? Now, there are a whole bunch of other transactions that happen in the economy that don't get counted in this. The biggest set are payments by businesses to other businesses. Right? So when a business buys something from another business, right, whether it's fuel to use in the business or they pay their workers, those prices don't count. If they go and make that payment right at the same kind of store where you would buy something, then they're paying the same price you pay. But their transaction doesn't count in figuring out this average, right? Because the focus is on consumers, right? So we measure these consumer prices. So what happens to taxes? Your taxes are money that goes to the government, and it's as if the government just reduces your income because you've got to pay taxes. Then the government goes out and spends that money, right? But those are purchases by the government, not by a consumer, and so they don't count in this index.
I have a question. Right now, China, of course, is trying to build a world reserve currency. It's my understanding from the numbers that I look at, they're stocking up on gold so they can have a gold-backed currency. So my question is, if the United States were threatened with their world reserve dollar and the petrodollar, what will happen to all those M3 dollars or those dollars that the other nations are holding if they repatriate back to the United States?
So that's a great question, right? The U.S. dollar has fairly special status in the international financial system in a couple of ways. One is that people all over the world like to hold actual U.S. currency, right? So we actually export lots of bills, lots of $100 bills mainly, and we ship those out in airplanes around the world. And there are lots of people who just like holding those. Right, now that's clearly a great thing for the United States because it doesn't cost us $100 to print a $100 bill, and then we can ship it somewhere else in the world, and someone's got it and they're happy, and we got $100 and it didn't cost us $100 to make it. Right, so there's a benefit to the United States that people like dollars for that purpose. Also, more broadly, people like to invest in U.S. securities, in particular U.S. Treasury securities. Right? And so they have to have dollars to do that. And so there are very large holdings of U.S. Treasury securities all around the world. And the willingness of people all around the world to borrow from the US Treasury means that the Treasury pays somewhat lower interest rates than it would pay if there were none of this borrowing. Right? So people have tried to calculate exactly how big that effect is. Right? And it's true that if one day we woke up and everyone all over the world said, we don't want the $100 bills anymore, ship them back today. And everyone all over the world said instantaneously, we don't want the Treasury bonds, sell them today, fire sale. Right? This could have a big impact. But there's no plausible scenario where that's what happens, where the whole world all of a sudden says, we don't want dollars. Right? Because historically what happens is financial systems change slowly. So China is trying to say, you know what, it would be great if more people use Chinese currency in international trade. That would be very convenient for us. We would get some of these benefits of people abroad wanting to have our currency. And China is trying to take steps to make that happen. And if China succeeds at that, gradually people will use more of Chinese currency, and perhaps that would mean they would use less of US currency. But you would expect this to be a very gradual shift, and you wouldn't expect that Chinese currency would completely take over the international financial system. Right? So even now, there are countries other than the US who are able to sell a substantial amount of their bonds abroad. For instance, Germany is able to sell a lot of bonds abroad. Canada is able to sell a lot of bonds abroad. Right? And these are much smaller countries than the US and have much smaller roles in global trade than we do, but nonetheless, they're able to have some holdings. So even if some other country steps up and is able to get its currency to have more of a role in the system, it's unlikely that what it would result in is all of a sudden no one holds any US stuff.
You and other Fed officials have claimed that the 2% is the optimal inflation rate that you're targeted at. And if this is correct, how do I, as an average citizen whose income rises at less than 2%, benefit from a 2% inflation rate? And if I don't, who does benefit from that?
Yeah, so that's a fantastic question because the Fed has very blunt instruments for tools. Right? We basically set one interest rate. Moving that interest rate up slows the economy down in general. Moving that interest rate down speeds the economy up in general. We aim at an inflation rate, and that inflation rate is an average for the whole economy. Right? And then different people have different experiences in the economy. So if you were to work out your personal inflation rate, it could well be, even if we're exactly hitting the 2% target for the average for the whole economy, your personal inflation rate could well be higher or lower than that, depending on which goods and services you buy. If you buy goods and services whose prices are going up very slowly, then your personal inflation rate would be less than 2%. And if you buy goods and services whose prices are going up rapidly, your personal inflation rate would be more. So people in the economy have very heterogeneous, very diverse experiences. And the Fed is not in a position, because of the macro tools that we have, to try to affect individual people's experiences. The best we can do is try to get the average. So the choice about 2% inflation being what we think is a good target is about what's best on average for the whole economy, but it's very important to admit that for any individual person, that may not be the best average, and you may well rightly prefer that we would pick some other number. Right? So why do we pick 2% on average? So first of all, on average, workers' wages over the long run tend to go up by the rate of inflation plus increases in productivity. So on average, in the long run, workers' incomes do keep up with inflation. That's obviously not true for every individual. Some people are in industries that are growing very rapidly with huge gains in wages. Other people are in industries that are shrinking and their wages may not grow or they might even fall. But on average, in the long run, workers' wages do tend to keep up. Right? So then we have to think about, okay, should they keep up at 2% or should they keep up at 0 or should they keep up at 4? At what way should they keep up? And people have settled on, many central banks around the world have settled on 2% as a good number for several reasons. So the first reason is that you want some margin of error above 0. Because what happens in a recession? In a recession, the economy is not doing well, and a central bank tries to cut interest rates so that it can get people back to work, get the economy going better, help workers get their incomes up again, help workers get jobs. And it's really important for the central bank to be able to cut interest rates and help people in that situation. But the lower inflation is, the lower interest rates tend to be in general, right? And you can never cut interest rates below zero, right? So if you've got cash in your pocket, it earns zero interest. And suppose we tried to make interest in banks negative. So you put $1 in the bank and you get 99 cents back tomorrow. Suppose we tried to cut interest rates that far.
Isn't that what's happening?
And so interest in banks is still not negative. But if we tried to make it negative, people would say, well, that's silly. Not putting my money in the bank, I'll just keep my dollar. Rather than put the dollar in and get 99 cents back, I'll just keep the dollar. So interest rates can't go below zero. But that means that we need to have room above zero to cut rates when there's a recession. And the lower inflation is, the closer we start out to zero. And then when the recession hits, the less room we have to cut, and the less we can help the economy, and the less we can do for workers who are struggling in that recession. So it's important to have some kind of margin of error above zero. Now, on the other hand, you don't want this margin of error to be too big, because the higher inflation is, the more costs there are from inflation. If inflation is high, then people have to constantly change their prices. Also, there are aspects of the tax code that don't work very well with inflation. If you make an investment and then it goes up in value just because of inflation, not because it was actually a productive investment, you'll get taxed on that. And so a high inflation rate would cause this tax distortion to be worse. And that means you shouldn't make the inflation rate too high. In addition, some research has suggested that the higher inflation is, the harder it is to control and make it stable. So you don't want it to get too high. Right? And then a fourth factor is inflation is this average of how prices are changing. Right? And in principle, we want prices for the exact same goods. Right? So in principle, what we'd like to do is see how does the price of a new 2014 Ford change between 2014 and 2015. That would be the change in price of the exact same good, a new 2014 Ford car from 2014 to 2015. The problem is when you get to 2015, they're not selling new 2014 models anymore. They're onto the 2015 models. Right? So the statisticians do some very complicated adjustments to say how is that 2015 model different from a 2014 model, and did that affect the price? And we want to take out the change in the price that just comes from it's a different model. But you can imagine this is a pretty hard problem. Right? So there are government statisticians, hundreds of them, who work very hard on this, and they do the best they can. But some research has suggested that you can't do it perfectly, and that as a result, the inflation rate we measure tends to be a little bit higher than the true inflation rate if you could actually have the exact same goods and services. Right? And so what that means is if we have a measured 2% inflation rate, the actual true inflation rate might be a little bit lower. So for all those reasons, people have compromised on 2% seems like a pretty good inflation rate to aim at. But it is really important to remember that for any given individual, you might wish that the Fed made a different choice.
I work for Wells Fargo Bank, and since 2008, I've started to notice that savings bonds are not as common as before. Customers used to come in and just get them done at the bank, but we don't have that ability to do that anymore. And I was wondering, is it because of technology you want people to do it online, or is there like reasoning for that?
So I know a little bit about this. So savings bonds are a product of the US Treasury Department, and the US Treasury Department, not the Federal Reserve, makes all of the decisions about them. But we know a little bit about this here at the Minneapolis Fed, because the Minneapolis Fed is the fiscal agent for savings bonds for the US Treasury. And so when people want to buy or sell a savings bond, that transaction is quite often processed right here in this building. Right? And so because there are people, more than 100 of them right here in this building who work on this, I know a little bit about it. Right? And so a few years back, the Treasury decided we're not going to do paper savings bonds by and large anymore. We're only going to do electronic ones. There's a little bit of an exception. You can, with your tax refund, get a paper savings bond if you really want, but that's the only way. And this has been common in the financial industry in general, that people are trying to move transactions to electronic systems. Right? It's more efficient. You have better record keeping. There's less concern about if a paper bond gets lost, where did it go and how do I find it? But it is true that some people like those paper transactions and they don't have that anymore. The Treasury would have to speak more directly to what were the trade-offs that led them to choose the route that they did. But it is true that a few years ago they went essentially all electronic.
The only problem with that is the fact that people that purchased the bonds were older people. So the newer generation doesn't really purchase them, and I'm sorry to say this, and I hope I'm not offending anyone, but the older generation doesn't really use the internet as much as the younger generation. So I think it makes it more complicated and would probably affect the bonds, honestly. So the transition might be efficient, but not really efficient.
Yeah, so the Treasury Department would really have to speak to how they weighed these trade-offs. You point out exactly the right trade-offs to think about, and the Treasury Department would have to speak to how they weighed them.
Do you have an estimate of the volume of securities the Federal Reserve System would have to sell to raise the federal funds rate, say 0.5%?
So here's what the FOMC has said about how it plans to raise interest rates when it does want to raise interest rates. You might think, well, what they did is they bought a whole lot of securities and issued all those bank reserves and built up the money supply when they were lowering interest rates. And so when they want to raise interest rates, they'll go in reverse and sell. But they've said that's not the plan, right? And the reason is it could be pretty complicated to sell trillions of dollars worth of Treasury bonds all at once, right? And that could be pretty disruptive, right? So the plan is different. There's a new law that was passed in the mid-2000s, just before the financial crisis, that allows the Fed to pay interest on bank reserves. Right? So it used to be, before that law was passed, that if banks had reserves with the Fed, that they didn't collect any interest on them, no matter what the Fed funds rate was. They had these reserves with the Fed and no interest. So you can imagine as the Fed funds rate gets higher, it's pretty tempting to the bank to just lend out those reserves because they're collecting zero interest, and the Fed funds rate could be 2, 3, 4, 5, so they lend them out. Okay. So now the Fed is allowed, if it chooses, to pay interest on the bank reserves. What does that mean? We can raise that interest rate as high as we want, and that will keep the banks from wanting to lend out their reserves, even if the Fed funds rate gets higher. Right? So what the FOMC has said is that their plan for raising the Fed funds rate is to raise the interest that's paid on bank reserves. If they would raise the interest that's paid on bank reserves by 50 basis points, then banks can collect 50 basis points, 0.5% more, for just leaving their reserves in the Fed. Now, what's the Fed funds rate? It's when one bank lends to another, right? So right now, a bank can, it turns out, get 25 basis points, 0.25% for its interest on reserves. And so banks do not want to lend to each other unless they can get more than those 25 basis points. If the interest on reserves goes up by 0.5% to 75 basis points, 0.75%, banks will not want to lend to each other unless they can get more than 0.75%. So this would push up the federal funds rate by the same 0.5% that the interest on excess reserves was raised. Right. Now there's a complication, which is it turns out that there are some things called government-sponsored enterprises, and these are things like Fannie Mae and Freddie Mac that guarantee mortgages, and the federal home loan banks. And they also get to hold reserves with the Fed, but they're not allowed to collect interest. So this creates a complication because we still have people out there who can't get interest, and the whole plan was we're going to raise the interest on reserves, and that's going to raise interest rates. Right? But we've got these people who don't get the interest. So the Fed has set up a second tool called the Overnight Reverse Repurchase Agreement Program. So a lot of big words. So what's the plan? The plan is that we're going to allow people or institutions, mainly things like money market funds that you might invest in, to make loans to the Fed overnight. There are some complexities. We give them some collateral for their loan. But basically, these other institutions are going to be able to make loans to the Fed, besides banks. And we can raise the interest rate on those loans also. What that will do is it will make sure that no one has an incentive to lend at a lower interest rate than the Fed wants. And so with those two tools together, the Fed can push up interest rates without having to sell the securities.
But it's never been done.
This is true. So I will say, so this reverse repurchase program has been tested quite thoroughly. They've changed the rate on it to determine exactly what effect that has in the financial market, and it does work as expected. But we won't know what happens when we raise rates until we raise rates.
Thank you for your presentation. Could you address, right here, could you address two issues on your graph about unemployment? Does it concern you that the labor participation rate has gone down as much as it has? And then a second issue, does it concern you the recent volatility on the stock market?
So first I'll talk about employment. So I only showed you one graph of employment, which is the unemployment rate. right? And then I mentioned that there are a whole bunch of other statistics that don't look as good. And so you bring up one of the really important ones, which is the labor force participation rate. So the labor force participation rate is the percentage of people in the country who either have a job or are looking for work. And why does that matter? The unemployment rate, we take the number of people who are looking for work and we divide by the labor force, the people with a job or looking for work. So if someone has totally given up on looking for work, they think it's just so hard to find that they're not even going to look, they don't count in the unemployment rate, right? Because they're not looking and they don't have a job. And they don't count in the labor force either. So one way that the unemployment rate can drop is if people just give up and stop looking, right? That would make the unemployment rate go down, but it would also make labor force participation go down. And no one would say that if everyone gives up and stops looking because the economy stinks that badly, that that's success unemployment, right? So we don't want to count that as success. Because of this, we do look very carefully at the labor force participation rate and other measures of how many people just actually have a job and how many people have, for instance, a full-time job, right? Because not only do you want people to have a job, you want them to have a good job, right? And those measures in general don't look quite as good as the unemployment rate, right? Because there was a big shift of people out of the labor force into what we call non-participation during the Great Recession. Some of that is actually a productive shift, people going back to school and getting more education. Right? So if you're in school, you're not in the labor force because you don't have a job and you're not looking if you're in school full-time and not working your way through school. Right? But that's productive because hopefully you come out of school with a degree and some learning that helps you produce more and earn more afterwards. Right? But others of it really is people saying, you know what, there's nothing there for me. Right? And that's a loss to the economy. So this is a problem for the US economy. One of the open questions right now is if the economy starts doing really well, how many of these people will come back in and how many are permanently lost? Right, and that, just like what will happen when we raise rates, we won't exactly know what's going to happen on that until the economy does better. Right? There's some estimates that suggest that most of the drop in labor force participation at this point has to do with very long-run demographic trends. You could see even before the Great Recession that labor force participation was dropping. Right? Then it dropped all of a sudden and then it kind of leveled off. But years and years and years have passed, so by now we're kind of close to where it would have been if it had just kept dropping slowly. Right? So there's some research that suggests that, but that research has to make a lot of technical assumptions, and those really are just assumptions. So it's also possible that a vigorous economy could pull many more people back into work. So as for stock market volatility, the stock market goes up and down all the time. It's a pretty random thing. I don't feel that I understand why it goes up and down a whole lot. I just know that it does. And so per se, that doesn't, speaking for myself personally, seem like a huge concern.
Sam, thank you for being part of this conversation. Piggybacking on the interest on reserves and employment numbers, as a point of clarification, is the Fed currently paying 0.25 to banks on interest on reserve? Is that right?
Yes.
Okay, and you talked about perhaps increasing that. Could there perhaps be some discussion or thoughts around maybe stimulating lending to small businesses to bring up inflation through the labor force? As we all know, I think small business is the true lifeblood of our economy rather than bank-to-bank inflation, a paper inflation measure. Any discussion on that, maybe how our banking system could work with Congress? Any ideas? Or maybe Minneapolis could spearhead that? Thank you.
Yeah, so that's a great question. It comes back to what I was saying about the Fed's tools being pretty blunt instruments, right? The Federal Reserve Act lays out very clearly what the Fed is and isn't allowed to do, right? And essentially what we're allowed to do, we can change the interest rate on reserves. We can change the discount rate that banks pay for loans to us. We can conduct open market operations, which means buying and selling securities in the open market, but only in very narrow sets of securities. We can buy obligations of the United States government, and we can buy municipal securities that mature in less than a year, and there's a few other very narrow things we can buy. So the Federal Reserve Act is very precise about what we can do. We're not allowed to just invent other things, much as we might think that other tools could be helpful for the economy. And so the Fed's hands are often quite tied on what we can do for the economy. So there are good reasons for this because the Fed has given an enormous amount of power, right? The Fed over the past, over the financial crisis created trillions of dollars and purchased securities, right? And the power to do that really is an important and enormous power. And so it's crucial that Congress circumscribes that in some ways. You wouldn't want to just hand over the authority to do literally anything, right? But on the other hand, that does mean that the Fed doesn't have instruments to do all kinds of different programs. The Fed cannot go out and say, you've got a great business idea, we think you need help, we're going to lend to you. That's just not allowed.
No, but I mean, rather than paying banks interest on reserves, aren't some other nations doing the reverse, right? If you sit on the money, we're going to penalize you versus we're going to credit you as a way to stimulate the economy?
Okay. Yeah, so that's a great question, right? So the Fed could choose to stimulate the economy, right? And we were talking about interest on reserves because the question is when the time comes, how would the Fed raise interest rates? So when the time comes, the Fed will raise interest rates by raising interest on reserves. On the margin, the Fed could probably stimulate the economy a little right now by cutting the interest on reserves to zero, right? That would provide a little bit of stimulus. On the other hand, that might cause some disruptions in the financial system of various sorts. For instance, money market mutual funds are required to have a constant asset value of $1. They can't, it's called breaking the buck if you have a money market mutual fund and the value of the shares in that fund drop below $1. Right? And if they couldn't get any interest at all, but they still had some expenses to run the fund, they have to pay the accountant to keep track of the money, this would make a real mess. Right? So you have to weigh, on the one hand, you'd get a little bit of stimulus from lowering the interest on reserves exactly to zero. On the other hand, you'd create some problems by actually setting interest rates exactly to zero. It's basically accounting problems, right? But you might think that having a bunch of people spending all this energy fixing accounting problems is not the best use of resources in society. So there's a trade-off there that policymakers have had to weigh, and where they came down was we're going to leave the interest on excess reserves at 25 basis points. But it's certainly, one would have to weigh these trade-offs, but it would be possible to lower that and produce more stimulus. Then the question is, should there be more stimulus? Right? So what the FOMC has said about its overall outlook is that they're looking to see some further improvement in the labor market, and they're looking to be reasonably confident that inflation is going back to 2%. And once they've seen those things, then they're going to be ready to raise interest rates. And so why are they thinking that way? As I mentioned, inflation expectations are really crucial to getting inflation to go where you want. And so the FOMC has to always make sure that people believe that it really is going to hit the 2% target. Right? And if the FOMC thought, hey, inflation is going to go past the 2% target, but we're not going to do anything, right? Then people would not expect us to hit the 2% target, and then we might have a problem with inflation going too high. So the FOMC is trying to hit this target and balance hitting this 2% target against doing the best it can on employment. And they've said that given that challenge, the best they can do is to think about raising rates when these events happen, when they're reasonably confident that inflation will go back to 2%, and when they've seen some further improvement in the labor market. Right? But that wouldn't necessarily be the time when they've gotten the most possible stimulus in the labor market. Right? You could imagine that the FOMC could decide, you know what, let's forget that inflation mandate, the price stability mandate, and let's just go all in on employment. And it's probably true that for some time, you could create a lot more employment that way. But the trade-off would be that you would lose price stability. Inflation would take off. And when that happened in the 1970s and early 80s, it was ultimately very damaging for the US economy. And it had to be ended with a recession that put huge numbers of people out of work. So although in the short run you could produce a lot of employment that way, in the long run it might actually be very damaging. And the FOMC has to weigh this and figure out what's the best way to handle these two goals, price stability and maximum employment.
Hi, I was wondering, so recent instability in China, how can that influence us? What if it goes even worse?
Great question. So, the first reaction a lot of economists have to what's going on in China is, hey, it can't be that big a deal, because although China has grown very fast, it's still not an enormous share of the world economy. The US doesn't do that much trade with China. In particular, we don't export that much to China. And therefore, China not doing well shouldn't have that big an impact on us. But I don't think that the reaction to what's going on in China is really about how much we export to China this year. The real question is, how fast is China going to grow? Right? So as China grows, we'll be able to export more and more to China, and that will create jobs in the United States and help the US economy grow. Right? Now, some people think that China is going to grow at 7% a year for the next 10 years. Other people think China is going to grow, but only at 4% a year for the next 10 years. Over 10 years, that adds up to a big difference in how much China will grow and how much the US will export to them. Right? So for people who maybe before were really certain it's going to be 7, and now they've seen some volatility in China and that introduces some doubt, the doubts they're having are not about how much we'll export to China this year. The doubts they're having are about in 10 years, how much will China have grown and how much will we be exporting to China then? Because that matters a lot for the long run growth of the US economy. And so this volatility in China can give some people doubts about what the long run growth prospects are for the world as a whole. And that kind of uncertainty can create all kinds of volatility in financial markets. So thank you all very much. I've really enjoyed the questions. They've been great questions, and I believe we have some refreshments outside.